China selling U.S. Treasury bonds gets mentioned all the time, but usually as a technical footnote, something for economists, something for bond traders. I think that misses what's actually going on. Because once you slow down and really think through the mechanics, what China is doing makes complete sense. And more importantly, it tells you something uncomfortable about the system we've all been living inside for decades. The dollar's role as the global reserve currency is one of the most lopsided arrangements in modern economic history. It gives the United States an advantage no other country has ever had. A country that represents less than 5% of the world's population is able to consume roughly a quarter of the world's output. That's not because Americans are uniquely productive. It's because the system is built that way. Here's how it works in practice. The United States buys far more from the rest of the world than it sells. It runs trade deficits year after year, decade after decade. Under normal circumstances, that would eventually cause a crisis. A country that spends more than it earns usually runs out of credit, but the United States doesn't. Instead, it pays for those deficits by issuing dollars and selling dollar-denominated debt. And because the dollar sits at the center of global trade, other countries buy that debt. They don't do it out of generosity. They do it because they need dollars to trade, to build reserves, and to protect themselves in emergencies. Think about it in everyday terms. If you and I spent more than we earned every month, eventually the bank would cut us off. Credit cards would hit their limits. Loans would get denied. But imagine if everyone around you needed your IOUs just to function. Imagine if your credit card bills could be paid by printing pieces of paper that everyone agreed were valuable. That's the position the United States has been in. China became a central player in this arrangement. It sold goods to the American market, accumulated dollars, and then recycled those dollars into U.S. Treasury bonds. At one point, China held more than $1 trillion in U.S. government debt. That wasn't an act of loyalty. It was the only place large enough to park that much money without breaking the system. But there was always a catch. By holding that U.S. debt, China tied a large portion of its national savings to political decisions made in Washington. As long as the financial system stayed neutral, that risk felt manageable. Over time, that neutrality eroded. Sanctions expanded. Assets were frozen. Payment systems were restricted. And when Russian central bank reserves were locked after the invasion of Ukraine, it forced a realization that couldn't be ignored. If reserves can be frozen for one country, they can be frozen for others. Legal arguments don't matter much at that point. Precedent does. Now put yourself in Beijing's position. You're openly described as America's main strategic rival. Trade restrictions are tightening. Technology access is being cut off. Military alliances are forming around you. And you're sitting on hundreds of billions of dollars in assets controlled by that same country. What would you do? You wouldn't sell everything at once. That would be reckless. You would start reducing exposure. You would spread risk. You would look for ways to store value that don't depend on someone else's permission. That's exactly what China has been doing. Treasury holdings have come down steadily. Gold purchases have gone up. Trade is increasingly settled in local currencies. Payment systems outside U.S. oversight are being developed. None of this is dramatic, but all of it is intentional. And once a country of China's size starts acting this way, others pay attention. To give you some perspective on the scale of this, when China held more than $1 trillion in U.S. Treasury bonds, that was more money than the entire annual economic output of many mid-sized countries. We're not talking about a line item on a spreadsheet. We're talking about sums so large that moving them even slightly changes the pressure inside the system. And this is where people often underestimate what's happening. Ask yourself this: why would a country willingly reduce holdings that large unless it believed the risk of staying put had become higher than the cost of leaving? Governments don't move hundreds of billions of dollars on vibes. They move them when assumptions break. We've seen this before. Remember Japan in the 1990s? Back then, Japan was the dominant foreign holder of U.S. debt. It financed American deficits while its own economy stalled. For years, Japan stayed locked into that position. But over time, it started facing its own pressures: aging population, slower growth, rising domestic needs. And today, Japan has been quietly reducing its treasury exposure, not because it wants confrontation, but because it can't afford to carry the same role forever. That matters because China is watching those same pressures play out in real time. China is aging faster than most people realize. Growth is slowing. The property sector is strained. Social spending needs are rising. In that environment, tying a huge portion of national savings to another country's political decisions becomes harder to justify. And then there's precedent. Think back to what happened to Iran, to Venezuela, to Afghanistan. Assets frozen, payments blocked, reserves made inaccessible. These weren't theoretical risks, they happened. And when Russian reserves were locked after the Ukraine invasion, it removed any remaining doubt about how far the system could be pushed. If you were sitting in Beijing watching that unfold, what conclusion would you draw? That reserves are protected no matter what? Or that they're protected only under certain conditions? That's the question China answered for itself. And the answer wasn't dramatic. It didn't require speeches or announcements. It showed up in balance sheets. Treasury holdings trending lower, gold reserves trending higher, trade deals written differently than they were 10 years ago. This is where the analogy becomes unavoidable. If you had most of your savings in one bank, and that bank made it clear it could lock your account during a dispute, you wouldn't empty the account overnight. You'd start opening other accounts. You'd move some savings elsewhere. You'd reduce exposure. That's not aggression, that's risk management. And once one large customer does that, others take notice. Saudi Arabia has started talking openly about selling oil in currencies other than the dollar. 10 years ago, that conversation barely existed. Now it's normal. Central banks are buying gold at levels we haven't seen in decades. That's not nostalgia, that's insurance. Here's the uncomfortable part for the United States. The system worked as long as foreign governments were willing to absorb American debt without hesitation. That willingness is no longer guaranteed. And when demand weakens, the adjustment doesn't happen in Washington first. It happens in markets. Interest rates rise, borrowing costs increase. The central bank steps in. We already know how that ends because we lived through it recently. More intervention, more money creation, higher prices. The cost shows up at the grocery store before it shows up in official statistics. People feel poorer even when the economy is described as strong. So when people ask why China selling treasuries matters, this is the answer. It's not about China winning. It's about the system losing one of the habits it depended on. And once habits change, they rarely change back. At this point, the important thing to understand is that none of this requires the dollar to collapse for the system to change. That's a misunderstanding a lot of people have. They imagine some dramatic moment where everyone wakes up and abandons the dollar at once. That's not how these things happen. What actually changes first is behavior. Countries start acting a little differently. They don't put all their reserves in one place. They write contracts with more flexibility. They build backups. And once enough players do that, the system stops behaving the way it used to. You can already see it. The United States now needs to issue massive amounts of debt every year just to function. Not for wars, not for emergencies, just to keep things running. And as interest rates rise, the cost of carrying that debt grows faster than most people realize. At some point, interest becomes one of the largest items in the federal budget. That's not a theory. We're already close. So what happens when fewer foreign buyers show up? The answer isn't mysterious. Domestic institutions absorb more. The Federal Reserve steps in more often. Money creation becomes routine instead of exceptional. And when that happens, the effects don't stay in bond markets. They show up in everyday life. Think back just a few years. Remember how quickly prices jumped after the pandemic stimulus? Food, rent, energy, insurance. Wages tried to catch up, but most didn't. People were told the economy was strong while feeling worse off. That disconnect wasn't accidental. It was the system choosing stability over purchasing power. Now imagine that process repeating, not because of a crisis, but because the structure demands it. That's the direction we're heading if demand for U.S. debt keeps weakening. China understands this, which is why its actions matter even though they look boring on the surface. Reducing Treasury holdings isn't about making headlines. It's about avoiding being forced to absorb the costs of someone else's choices. And China isn't alone in reaching that conclusion. Countries that used to rely entirely on the dollar are now building alternatives, not to replace it, but to limit exposure. That's an important distinction. They don't need the dollar gone, they just need it less dominant. Once that mindset takes hold, the world starts to look different. Trade becomes more regional. Currency blocks form. Financial shocks travel less smoothly across borders. Power becomes harder to project through finance alone. Influence costs more to maintain. None of this means the United States stops being powerful. It means power becomes constrained by trade-offs again. And trade-offs are something the system hasn't had to confront seriously in a long time. That's why this moment feels uncomfortable. The old setup allowed problems to be pushed forward. Deficits didn't force hard choices. Debt didn't impose immediate discipline. Now those buffers are thinning. So when you hear that China is selling US Treasuries, don't think of it as a hostile act. Think of it as a signal that the assumptions holding the system together are being re-examined. Ask yourself this: if you were running a country, would you want your future tied to a system that requires constant borrowing, constant intervention, and constant trust that political lines won't be crossed? Or would you start building options while you still can? That's the calculation being made right now. And once enough countries reach the same conclusion, the system doesn't break. It evolves. Slower growth, more friction, fewer free passes. The world the dollar built isn't disappearing overnight, but it's no longer unquestioned. And when that changes, everything built on top of it has to adjust. That's the real shift underway.